So until recently, Alfred, a lot of economists and strategists thought that they'd actually stay on the sidelines, but it looks like Bank of Canada seems to think that our economy can withstand higher rates. Do you think they're right?
Well, it seems like it. I mean, as you mentioned, we got another quarter point rate hike by the Bank of Canada today, which didn't really come as a surprise given that the market was pricing in roughly about a 60% chance that we're going to get a rate hike. But I think, this is a clear indication that the Bank of Canada has transitioned to a policy that is going to be data dependent. Even though we've got two consecutive meetings in which we raised rates, that doesn't necessarily mean that we're moving back towards this aggressive shift towards aggressive tightening. I think, as I mentioned, it's going to be a little bit more data dependent. I think Canada has been very fortunate in the sense that we've been aggressively hiking rates over the last year, but we haven't really exposed a lot of systemic risk in the system. So similar to what we saw with the UK with the pension plans back in last fall, more recently with the US and the regional banking crisis back in March, we haven't really seen any systemic shocks to our system. I think you got to credit the banking system in Canada for that. But I think that doesn't necessarily mean that we don't have our own concerns as well. I mean, household debt is still at record levels.
Yeah.
I think every incremental move is going to be, even more felt by the Canadian consumer now. So I think, uh, the good thing is that from the Bank of Canada's point of view, with every incremental move, that means there's going to be less discretionary spending for the Canadian consumer, which hopefully we're going to see a lot of those discretionary service items start to come down, hopefully in the next 3 to 6 months.
Yeah, it's interesting that you say that, Alfred, because I just read a report that says half of Canadians say that they're about $200 away or less from not being able to pay their bills at the end of the month. I've seen this data time and time again. But yet, consumer spending seems to be resilient. The labor market is resilient. What do you make of this? Is there a discrepancy?
I think there's a few things going on. I mean, I think a lot of the people, in terms of their mortgages, they've, only a few have refinanced over the last year or so. But, as you know, in Canada, the mortgages aren't as long term as we have in the US. So what that means is that over the next couple of years, we're going to see a lot of these mortgages kind of reset to higher rates, which is going to have an impact on that discretionary spending. So, as I mentioned, with household debt still at record levels, but once we see some of those mortgages kind of refinance to higher rates, that's potentially when we see a lot of that discretionary spending fall off. And keep in mind, I think, over the last 3 years, obviously with the lockdowns and everything, people have been cooped up. And I think the first thing that everybody wanted to do was go out to the
Yeah.
favorite restaurants and go and take a lot of these vacations that we haven't been able to do so. So I think that's been the impact. A lot of that revenge buying, as they like to call it.
Alfred, you talked about mortgages. Now, mortgage costs are contributing to the inflation figures, even though, like I said, it is coming down. This does mean a lot of more pain for mortgage holders. Ones that have fixed, and that's they might be up for renewal at the end of the year, and also the variable mortgage holders. What do you think this could mean for the economy?
Well, in terms of the real estate market, I think the real estate market has been surprisingly very resilient over the last year. So as we've seen these interest rate hikes, the real estate market, especially in key areas like Toronto, we haven't really seen those housing prices fall off. I mean, they
Mhm.
did drop a little bit over the last, couple of months, but as interest rates have leveled off now, we're starting to see a lot of multiple bids in certain areas, and I think that is due to supply shortages, for example. There's not a lot of new housing permits being given. So I think there is going to be a supply shortage. So I think the real estate market here is very different. And when you add on top of that, 500 new, immigrants coming into Canada over the next year, I think there's going to be more resiliency in the real estate market in key areas.
Yeah, definitely. When you think about a million or so is the target for immigration, we know that it has to match the housing policies, and we're not seeing that. We're going to take a quick commercial break. We'll continue this conversation when we come back.